Now, another important lesson is knowing the difference between retracements and reversals. This is a vital key in your trading because this will tell you or show you, if let's say you're in a trade, whether or not you should close the trade or leave it open. Because a lot of the times, for example, let's say we buy on GBP USD and we in profits. Let's say we in $1,000 profits, and let's say we've never been in $1,000 profits before, and all of a sudden we see it goes to $1,000, and now it starts decreasing. 950, $900, 870, $600, and now we're like, oh no, we better close now. I better close this trade now because I could have, I don't want to lose all this money. I've already lost $400 because it was at 1,000. Now it's at 600. Let me close my position. And let's say your take profit was way on top. So you close your position at $600. You're happy with the $600 because you made $600 right now. And let's say tomorrow you look at the chart and price would have hit your take profit, and the amount you would have made on your take profit is, let's say, $3,000. So did you profit $600, or did you lose 2,400? You understand? So identifying, if you can identify whether it is a retracement or reversal, you will know, okay, you know what? Yes, it's going $600 down, okay, but it's making a higher low. It's hitting the 78.6% Fibonacci. It's hitting the support zone. So it's most likely going to increase. It's most likely going to continue to make higher highs where my take profit is. So maybe I can enter even more positions now, on the retracement. So now, what is a retracement? What is a reversal? And how can you identify the difference between the two? So first one is obviously your retracements. Now, your retracement is defined as a temporary price movement against the main trend. So what I mean is, let's say the trend is, let's say, bearish. Okay, the trend is a downtrend, meaning the overall movement is downward. The price is decreasing overall. A retracement is a temporary price movement against the main trend. So this main trend is downward. So there's a price movement that will go up, but it's temporary. It doesn't go all the way up, until Timbuktu. Okay, it'll reach a certain level and then continue going down. Same for, a bullish move. The retracement would be going down. So, it's where the movement of price moves against the trend and then continues the trend. You remember the higher highs and higher lows. So if you're looking at an upward trend, it makes a high high. Your higher low is the retracement. So from that point, that peak, the higher high, it comes down to form the higher low. That downward little move is known as your retracement. Okay. Same with the bearish. So it happens all the time. Remember, the markets are like a wave. People call it, wave, Elliott wave, whatever the case might be. Okay. This is where the wave effect takes place. And it's all about the patience, right? Like I said, you might see your profits decreasing. You need to control these emotions, okay? The emotion of self-doubt, the emotion of fear. Okay, you're scared to leave the trade. You're doubting your analysis, and all of that kind of stuff. So don't panic. Be patient. Wait for it. It will continue, unless it turns into a retracement and a reversal, and then that's when you'll manually close it. So as you can see, in an uptrend, the red arrow shows you retracements, and then in a downtrend, the green arrow will show you retracements in the downtrend. So it's those little moves, against the trend, like I said. Here are two practical examples. So the highlighted ones are the retracements. So as you can see, the first one is an uptrend. So the overall move, the big moves are going up with green candles. Remember, bullish candles. And you can see a few red candles coming down and then continuing with bullish candles. So these little moves with red candles are your retracements. And then if we look at the downtrend, it's the opposite. Your major downward move, okay, its price is decreasing, you'll see big, long, or a lot of red candles, okay, that's the majority of the candles, so you know it's a downtrend, and then you'll see small bullish candles, just retracing. That is your retracement. All right, so this is the pair USD CAD on the 4 hour. Okay, it doesn't matter. What I want to show you is sort of retracements. So as you can see, there's a lot of consolidation here and whatever. So what I'm going to do is, as you can see, this is the last sort of, there's a resistance here. As you can see, there's a break and retest. So I'm going to start over here. I'm going to remove this quickly. So we're going to start here, and I'm going to name it higher high. Okay, because it's higher than the previous high. All right. Now, as you know, it broke structure. You can see this this move here. That's an impulse move, right? So we'll get into that. Make it thicker. Okay, so that's a bullish move. And then a retracement happens. This is a retracement. It falls back to a lower price. Okay, falls back to a lower price and forms a high low. High low. Then price pushes up again to form a higher high. New high high. So as you can see, this is a bullish move. So what's coming up? A retracement to form the next higher low. This is the retracement here. Retracement forms a higher low. Then another impulse move. Okay, I'm just going to take the bigger move. I'm not going to take these small moves. Comes there, forms a new higher high. Okay, after the higher high, price gets exhausted. It retraces back to a lower price. This is the retracement. And forms a new higher low. Okay, and then again, and boom, higher high. Retraces back to an equal low. Okay, so beware of this. It's indicating that price is most likely going to reverse, which it eventually did. This is where your trend lines would come like this, like that. Let me just, then we'll go. There's your trend line. So break, retest, sell, and then as you can see, but yeah, that's in the trend line video. So as you can see, these are the retracements. These minor moves here. Retracement. 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 That's in an uptrend. Let's see in a downtrend. So this move, let's start on the top. Okay, after this break. So as you can see, there's a lot of consolidation here. Break below. Okay, so we have our move to the downside. Forms a lower low. Retraces back up to form a lower high. This small move is your retracement. Impulse move comes down to form a new lower low. Retraces back up to form a new lower high. Oops, I did something. There we go. Then price comes down, lower low. Retraces up to form a lower high. So price will come down, form this lower low this time. If you don't understand the market structure, go back to that video. Retraces back up to form a lower high. Then impulse move pushes down to lower low, and then price retraces back up to form a lower high. So let's say you sold here at this point. You sold here. You sell. Right. Okay, you sell. And now price moved. Let's say you sold there. Boom, boom, boom. Price moved $128. Okay, that's 128 pips. Let's say use a 0.10 lot size and moved $128 in your favor, profit. So you're making $128. Then all of a sudden you see 127, 120, 118, 109, 100. How is your, this is why psychology is important. How is your emotional side going to feel? You losing money. Goes to $87. From 128 comes to 52. You're going to think, oh snap, let me close it, while I can. No. It is a retracement. Never close. Retracements are there so that you can re-enter. So let's say your take profits all the way down here. Whoopsie. Sorry. Let's say your take profit is all the way down here at $360. So it's $360. Okay. Price is going to retrace. So you have to, if you sold there, you have to hold it. If your take profit is 360, leave it. There's ways that you can close partial profit. There's ways that you can put your stop losses past entry and stuff. Okay, I'll show you all of this in the paid course. But there are ways to secure your account. So you don't have to fully close that position, because imagine you close at $52. You closed there because you got scared, you doubted yourself, you feared that you were going to lose money. Tomorrow you look at, it went all the way down to your take profit at $360. So you lost $310 basically, because you lacked the patience, you were fearful, okay, you doubted yourself. So what needs to happen is, once a retracement happens, you need to reanalyze. This is why it's important to monitor your trades, because you can go like, you can put your Fibonacci and be like, neglecting the 61.8%, you go on lower time frames, that's a candlestick confirmation. Let me add another sell. So you add another sell over here. So you add into your position. Okay, there's more on adding position again in the paid course. But comes down, retrace, you add a sell until it hits your take profit. Those are the retracements. Retracement. I hope you understand this. It's relatively easy once you grasp the concept of it. You just need to practice and identify. So those are retracements. Next one is reversals. So a reversal is a whole change of the overall trend. So it's from a downtrend, it reverses up into an uptrend. So it's not a retracement and then continuing with the same trend. So it's not like we did before where if it's in a downtrend, you have a little move to the upside and then it continues with the downtrend. No, this is a complete change. So it's from a whole downtrend converting back up to an uptrend, or from an uptrend into a downtrend. Now, three options when you face sort of a retracement or reversal, right? First one, if you are in a position, okay, if you are in a trade that you can hold, remember it can lead to losses if the retracement turns into a reversal. Okay, this is why it's always good to monitor, and those who are on the signals group and who have done the course, you guys know I like to close partial profits. I like to set stops past entry in case, you know, a reversal happens instead of a retracement. Especially for me, that I can't really always monitor my trades, although it's vital for you to monitor your trades. It's good to check every now and again. But if you cannot really identify, or you know, if there's sometimes, you know, you get busy with something and you don't realize, and at that given point in time, a reversal happens instead of a retracement, then at least you're covered with your stop loss past entry and, you know, partial profits being taken. So number two, like I said, you can close your portion, okay, and re-enter if the retracement is confirmed. So if this is an option, okay, I prefer to keep it, but this is an option where if with that sell, you sold, okay, went down, let's say it went down to $200, you can see now it's retracing up. You can close that position fully, okay, so you make, let's say, $180, and once it hits that retracement, you can reanalyze, okay, when, you know, you can see the market starting to continue with the trend, and then, you know, analyze, put your Fibonacci support, whatever, then you re-enter another trade. Okay, thing is, you can miss a trade opportunity if the price moves sharply in one direction, and money may be wasted on the spread if re-entered. So that's another thing. Because you close, that's the issue with this. Because you're closing your trade fully, when you re-enter the trade, you have to pay spread again. You have to pay your broker the spread. Whereas if you left your trade, okay, you just had to deal with the patience, wait for it to retrace, and then once it continues, sorted. You didn't have to re-enter, so you didn't have to pay spread again. So it's entirely up to you. And then number three, you can close the trade permanently, okay, whether it's in a loss or a profit. Now, a reversal, okay, the first one is a reversal from an uptrend to a downtrend. So in the uptrend, price made a higher high, retraced down to make a higher low, then impulse moved to form a higher high, and then you can see price pushed past that higher low, not making that a higher low or an equal low, pushed below it, forming a lower low. This is an indication that price is most likely going to reverse and retrace back up to form a lower high, testing that previous high low, and then continue down. So it changed from an uptrend to a downtrend. And then the opposite for, you know, a reversal from a downtrend to an uptrend, where the main price, the main sort of market structure is bearish, okay, downtrend, price formed the lower low, lower high, lower low, and then price went past the lower high, forming a higher high, indicating that, you know, the price may reverse, okay, from a downtrend to an uptrend, which it did. Came down for the high low, didn't go to a lower low, so it is confirmed that it changed from a downtrend to an uptrend, and then it continued going up. Here is a practical example from an uptrend to a downtrend. So as you can see, your highs and higher lows, and then a lower low pushed, you know, below that latest high low, and then retraced up to form a lower high, and then you can see price then continued further. Same with the downtrend to an uptrend. Now, reversals can happen any given time. It doesn't matter what strategy you have, if you have the best strategy or the worst strategy, how accurate your strategy is, it can happen anytime. So choosing the best option out of those three, all right, is very important, but it's also difficult. Okay, there's no right or wrong way. Because reversals can happen anytime, it is important to set stop loss pass entry or to use a trailing stop, which is part of risk management. Now, if you can properly differentiate the difference between a retracement and a reversal, it will reduce the number of bad trades. Because remember, if you sell and it's making high highs and high lows, okay, you're dealing with the retracements, and then you see a reversal happen, you're still in profits but not as much, you can then close the trade manually and you'd still make profits. It's not like, retracements happen and then a reversal happens and you're still in the position and then it hits your, goes past your entry, hits your stop loss. So many, differentiating a temporary price change, retracement, okay, from a long-term trend, and here are the differences. So for a retracement, it occurs mainly after a big directional price movement. A reversal can occur anytime. Retracement is short term, reversal is long term. Retracements, fundamentals do not change it. Fundamentals change to reversal, like the main fundamentals might. So NFP, unemployment, fundamentals like that. All right, this is a continuation of the sort of retracement example on USD CAD, but I want to show you basically on the reversal. So as you can see, price made an equal low this time. Equal low. What's this? Okay. Anyways, equal low, and then price pushed up further, making another higher high. Higher high. So we're still in an uptrend. Okay, it's just giving retracements. As you can see, price came down to retrace and formed a higher low because it's higher than the previous low. And then this happened. Price came up and could not break that previous high. It hit the same level. Okay, this is known as a double top formation. It's in market formations. So it made an equal low, equal high, equal high, and then you can see price pushed all the way down. You think it's a retracement over here? Nope. Price pushed down to this level. Now, this is the previous high, higher low, sorry. As you can see, price broke below it, forming a lower low. Lower low. So that is an indication that price is reversing into a downtrend, from an uptrend to a downtrend. So if you were let's say you bought over here and your take profit is all the way on top, so you profiting, and then you see this reversal. It didn't hit your take profit. So now you close manually because you know it's about to reverse. Okay, so now you know you need to start looking. Not yet. So what will happen is price will come up, retrace, testing this high low as a lower high. Lower high. And now this is where you start to look for sells. Because now it's lower low, lower high, lower low, lower high, equal low. Broke above. Let's continue. Let's see where this goes. Equal low. I'm just going to do this. Equal low, lower high, lower low, lower high, equal low, higher high. This is a double bottom now. So what's going to happen is, let me just write out the names. This is an equal low. Lower high, lower low, lower high, equal low, right? Pushed above that previous market structure, right? Lower high. Now form the higher high. So what's going to happen? Can you see the pattern? So what's most likely going to happen is price is going to come down to this level, form a higher low, form a higher low, and then it's going to continue going up to form a higher high. Then it's going to come down, form a higher low. Then it's going to come up, form a higher high. And then who knows, maybe it comes down, forms a lower low. Then it's going to form a lower high. Then a lower low. And that is how the market works. That is, you know, between a reversal and a retracement. Now, how to identify retracements? First one is Fibonacci. Now, there's a section on Fibonacci explaining what it is and everything, but in the paid course I explained how I use it. But I mean, the Fibonacci sort of lesson in this course, it's just as good. So you can use your Fibonacci levels to identify how far a retracement will go. I mean, if it goes past 100%, it's a reversal. But if it goes to the 23.2%, 38.2%, 50%, 61.8, 78.6, whatever percentage within the Fibonacci, then you know that's most likely going to be a retracement and not a reversal. Okay. So that, now, as you can see there, price made a higher low and then a higher high, and then retraced to the 61.8%, made a higher low, and then continued. As you can see, that is a retracement. Number two is with trend lines. So you should know what a trend line is by now, especially after the trend line lesson. So if you don't know what a trend line is, please go back to that lesson. So once a major trend line has been broken, a reversal will take place. But if it bounces off, it is a retracement. As you can see there, with the sort of red circles, that's showing the trend line support. So that's making higher lows. Those are the retracements, retracing, and then where that block is, that's the broken trend line. So potential reversal. As you can see, price broke the trend line, formed the lower low, you know, showing you that there's a potential reversal, and then price came back to retest the trend line, and then formed the lower high, and then it was a downtrend. So from an uptrend into a downtrend.